All right, everyone. Thank you very much for those of you who are here on time. As always, we'll give it a couple minutes to let others come in. So while you're waiting, get comfortable, grab your cup of coffee, grab your glass of water, run to the bathroom, whatever you need to do, and we'll start right at 12:02. All right, and that is 12:02. So let's get to it. Again, thank you for everyone for coming to today's webinar, Key Multifamily Financial Assumptions for 2026 with Rob and Clay Stanley from Shining Rock Equity. Before we get started, we have the obligatory disclosure. So, as you have all heard me say before, this presentation is going to be for educational purposes only. Cam Plan doesn't provide any investment or tax advice, and we always encourage investors to go and do their own due diligence before making any kind of investment or tax decisions. And we encourage you to go get the counsel from the correct professionals, advisors, CPAs, tax professionals, etc. Also, we'll have the chat feature turned off, but please ask your questions through the Q&A function. Um, I'm going to be asking questions, but I don't want to be the only one, so please let's make this a dialogue. I had the opportunity to chat a little bit with Rob and Clay beforehand. They're completely nice. They don't bite, so please ask your questions and let's have a lot of fun. Lastly, if you have any questions about self-direction, something doesn't get answered during this presentation, or you just want to ask me a question about something else that you heard related to self-directed IRAs, you can reach out to me directly with that contact information in front of you, as well as schedule a call with me with the QR code there. All right, that's enough of me talking. Stop sharing my screen and turn it over to you guys.
All right. All right. Well, thank you. Hi, everyone. I'm Rob Stanley, managing partner at Shining Rock Equity, based here in Chapel Hill, North Carolina. I'm super proud to be here with my son and business partner, Clay Stanley. Um, Thank all of you guys for tuning in today, and thank you to Camaplan for inviting us to present today. So the goal is to give you a clearer look on how deals are being underwritten right now. A lot has changed in this market, and small assumptions can have a big impact on returns. So we'll walk through what we're seeing, where things can go wrong, and how we think about evaluating deals in today's market. We welcome questions throughout, and we'll also save some time at the end for some Q&A. So I'll get started with a little bit of background on myself, the team, and Shining Rock. Um, so I've been in real estate for 30 years, and over that time, I've worked with institutional investors and acquisitions, portfolio management. A few years ago, we formed Shining Rock Equity really to facilitate our making our own personal investments, and soon we realized we could also help others in our networks access high quality investments as well. To date, we've partnered with main sponsors on six single asset multifamily deals representing more than 1,200 apartment units, along with one private credit fund. Across those opportunities, close to 60 investors from our network have joined us in these investments, many of those coming back as repeat and even some three-time investors. And that's something we're super proud of. In my role with Shining Rock, I focus on day-to-day operations, compliance, developing partnerships with investors. So before I turn it over to Clay, I'll mention our other two team members. Kim Solomon, my sister-in-law, who is a top producing residential agent here in Chapel Hill. She's a true master connector of people And as such, she's a perfect fit for her role in investor relations with Shining Rock. Also, we have my wife, Sarah. She has her own graphic design company, S Square Design, and she oversees our marketing efforts. So as you can see, we really are a family business. And with that, I'll turn it over to Clay.
Sure. Thank you, Dad. As you said, my name is Clay Stanley, and I will provide some brief background on myself. I started my career about 6 years ago doing single family acquisitions for a firm based in Charlotte and got to the point where we were handling the acquisition process for 200 to 300 homes per month. Did that for 3 years. And then for that same firm based in Charlotte, I currently handle all of our land acquisition for our residential development vertical. And that's all based in and around Charlotte, North Carolina. In addition to that, of course, I started Shining Rock Equity with my father here, and it has been a fantastic experience. We formed the firm in 22, did our first deal in 23, and I handle much of our financial analysis. That's where a lot of my experience has been elsewhere. So I handle the financial analysis piece for Shining Rock Equity, and I'm the one digging into the spreadsheets and making sure that we're making the correct assumptions there. But Shining Rock Equity as a whole today, we are focused on due diligence of deals and the operating partners that are going to run these deals and make the decisions that will dictate whether we're able to meet or exceed our projected returns to investors. And so we're very careful about who we are putting in front of our investors. Um, so today's conversation requires a little bit of a backdrop to figure out how we got to where we are today and where the opportunity might be ahead, coming up. So back, let's say 2015 to 2019, we'll call those normal years. We had relatively normal supply, normal absorption, meaning demand, and reasonable rent growth in the 3 to 4% range. So it was a good time for multifamily. Things were stable. Then we had COVID, which thereby decreased interest rates because of all the stimulus that the economy needed at that time. And then you had a huge demand push during that period of time for multifamily apartment units, especially in the Sun Belt. So you had rent growth that was quite frankly off the charts. You had extremely low interest rates, and because of those two items, you had apartment prices, what it costs to buy an apartment building, you had those skyrocketing as well. And so that, developers saw that and developers said, you know what, this is a great time to build. We can have cheap debt and prices are high. Let's go build a ton of apartment units. And that's exactly what they did, especially where it is easier to build in business friendly states like Texas, North Carolina, Phoenix, all across the Sun Belt. And so a lot of apartment units got built, and it takes a couple of years for those to actually deliver to market. And so starting in about, late 23, 24, 25, a huge influx of supply came online, and that has decreased rents, either rent growth or even we've seen negative rent growth in some markets all throughout the Sun Belt. But this is not necessarily a national problem. It is a short term supply problem within Sun Belt markets. And so those same Sun Belt markets are still great for investment for various other reasons, population growth, job growth. But it's about how figuring out how you can invest through that supply cycle. And so that's where we see the opportunity today. And in specific markets, we think that you can buy properties today at compressed pricing and benefit from the growth that we expect in the future. So here's a chart showing the starts, and it doesn't go all the way to today, but we do have the data for the remainder of 2025 there. And as you can see, going back to 2021, we see demand that is extremely high, and then demand drops off and starts are increasing dramatically. All of those starts, which is the green line there, are getting delivered, 24, 25, And so we still had really strong demand during that period. That's the blue line. The demand was really good in 24 and 25. But supply was even more aggressive, and especially in many Sunbelt markets. And so that's what caused rent growth to either stabilize at 0 1%, something like that, or even decline in places like Austin and Phoenix. Um, and so if we move on to the next slide, we can see that stabilization or that decreasing rent growth in this is nationally, but some markets are still increasing, and we'll see the dichotomy there about which markets are still increasing and which markets are decreasing currently. We can move on to the next slide. So in places like San Francisco, where it's really hard to build and demand has rebounded because of the AI boom, you see 9% effective rent growth, which is quite frankly incredible. And all of these markets here, for the most part, are markets that are a little bit slow and steady. They don't have huge population growth, nor do they have huge job growth. Yet these are the top markets for rent growth, which is the complete opposite of where it was 5 years ago. Because you think rent growth, you think job growth, population growth, that's all the Sun Belt, but that's also where all the supply came online. So what this chart shows, and what the dichotomy between the two types of markets, with Sun Belt being one and slower job growth, slower population growth markets being the other, what you see is that this is a supply equation. The demand is there, and rent growth is continuing in places where supply did not come online as aggressively as others. Even Cleveland in there is showing some rent growth despite stagnant population growth and stagnant job growth. And next slide. These are the markets. All of these markets that we think of as huge job creators and huge job growth markets, these are the ones that are having the highest concessions, where rental rates have stabilized or even come down. Charlotte's in there, Nashville, Houston. These are the markets where you have to be extremely careful right now. You might be able to purchase property at compressed pricing because revenues are down. So that's where the opportunity lies if you can buy in the right submarket, but it's very much submarket dependent. For example, we see Houston on here as a market that's offering a high amount of concessions. At the metro level, that's absolutely true. I'm actually sitting in Houston as we speak right now and toured a couple of properties, and it's very apparent which ones are struggling from the increase in supply within their particular submarkets. My dad and I all have invested into a couple of apartment complexes within the last couple of years in Houston. And because those complexes sit in a submarket that has extremely low new supply within a 1 to 3 mile radius, we're actually seeing rental increases at our particular properties. But if you look at the metro level of Houston, the metro level rents are actually down about 2%. So it just goes to show, if you can find the right submarket to invest in, then you can benefit from some of that growth here in the coming years. And so the opportunity today, we believe, is in properties where maybe the current owner has had to offer concessions to get people in there. And if we can come in and buy at compressed pricing because the previous owner was having to offer, let's say, 1 or 2 or even 3 months free rent just to get tenants in there, if we can come in and buy a property and stop offering those concessions to bring people in, well, just right off the bat, you're looking at a 10 to 20% increase in your effective rents at the property. And that's if market rents stay flat. So this does not require that market rents increase. This just requires that the property stop offering concessions. And so the tricky part is, and where you don't want to catch a falling knife, is if you buy a property and you expect to burn off concessions, but then you actually have to continue to offer concessions for the next 3 years. That's the risk. And that's what you're going to try to avoid by making sure you're investing in a submarket that doesn't have a huge amount of supply coming online, even if you're investing in a metro that has a fair amount of supply. So very much, and my dad will get into this later in the presentation, but you have to look within that 1 and 3 mile radius. This is just an interesting chart. Quite frankly, I wanted to throw in here. It shows investor sentiment essentially. It shows the purple line is let's call it fundamentals of multifamily real estate, whereas the blue line is pricing. And so we saw that pricing increase dramatically, well above where fundamentals were in that 21 era, which created some of the problem or some of the short-term oversupply that we're seeing today. And then now we see fundamentals are not quite as bad as pricing is. This is at a national level. I just thought it was an interesting chart to show investor sentiment, but we can move on to the next one here. This again, and this plays into where the opportunity is today. Maybe I haven't made that exactly clear, but supply in most markets throughout the Sun Belt is essentially dropping off a cliff. We went from extreme starts, which led to extreme supply and in the short term oversupply. But because of two main factors, one of them being the huge increase in interest rates we saw in mid 22 and that continued. And then we have, excuse me, we have continued volatility today. So you have interest rates that are high and volatile, and then you have high construction costs. So those two items have caused developers and multifamily starts to drop off a cliff, which we are now currently experiencing. Q4 2025 was the lowest supply or the lowest delivered multifamily units that we had seen in 3 years. And that's continued into the first part of 2026. We got the numbers out recently, and we had two things happening. We had supply that was continuing to come down and stabilize back to, let's call it pre-pandemic norms from that 2015 to 2019 era. And then the next thing that you had was the absorption numbers came out. Q1 multifamily absorption was about 94,000 units, somewhere around there, which is quite frankly a pretty good quarter if you're looking at historical standards. So if we can take pretty good demand and that continues, which, you know, it's hard to say if it will or not. Supply is easier to forecast than demand, but let's assume demand continues and supply continues to drop off. Well, then that's the recipe for number one, occupancy increasing, number two, concessions burning off, and then number three, eventually organic market rent growth. And so that's what we're trying to buy into right now when we're buying at compressed revenues.
Clay,
And we could see that supply drop off there.
can I interrupt you for a
Absolutely.
second?
Yeah.
You might have said this, but can you repeat the reason that the supply dropped off in 25 and or I guess the supply dropped off in what was delivered in 25 and 26?
Absolutely. And that's the increased construction costs and the increased interest rates. So it takes a couple of years for these apartment complexes to actually be built. And so in mid 23, when we were experiencing the high inflation that, you know, went to construction costs increasing, that the interest rates increasing and continuing to be volatile, those two factors decrease the amount of starts happening in late 23 into 24. And so now, because of those compressed starts in 23 and 24, we're seeing the less supply in 25, 26, and 27.
Okay,
Yeah.
thank you.
Absolutely. And this is just another chart showing the decrease in the drop off in expected supply here. And this has largely come to fruition. These blue lines here are forward looking, but we have the data now. This is a little bit of an outdated chart, but now that we have the data, we can confirm that this is in fact happening. Supply is in fact burning off.
Yeah.
And then here just shows again that this is a short-term supply issue and not a demand issue, because you're seeing places that don't have huge amounts of demand continue to clip rent increases, whereas the markets that we know have huge amounts of demand and job growth and population growth, we see those markets seeing rental decreases, and it's really all due to the supply in those markets.
All right. Thank you, Clay. As Clay mentioned, It's no longer about just picking a strong city to invest in. It's about picking the right submarket. So no matter where you're investing, but particularly in the Sun Belt, you really have to be selective. Some areas are still absorbing a lot of that new supply you mentioned. So one of the things we focus on is new supply as a percentage of the existing stock. And we want that number to be at 2 to 3% or less, depending on job growth and absorption. And we don't just look broadly, we zoom in. 1 mile radius tells you, your direct competition. 3 mile radius shows broader pressure. So as a limited partner, the question is worth asking any operator considering investing with, what does new supply look like within that 1 and 3 miles of the property? Um, and then for the assumptions that we're, spending a lot of time looking at these days, a few things that we see consistently. First, deals that are layering aggressive market rent growth assumptions on top of renovation premiums. In this environment, it's really tough to support that. Second, rent growth assumptions in markets that aren't growing. Third, we see models that assume concessions burn off too quickly, as Clay mentioned before. Um, and we also are paying close attention to renewal risk, meaning tenants moving for those concessions, thereby increasing turnover costs that are understated in underwriting models. And then the big one is gain to lease versus loss to lease, and we'll walk through that in just a moment. So at the end of the day, the question is simple: is rent growth actually coming from the market, or are we relying on pushing in-place rents? Um, and so gain to lease versus loss to lease. It's very important to understand. So loss to lease is the gap between current rents and where the market is today. Gain to lease is the opposite. Market rents are below what tenants are already paying. So what matters is whether that loss to lease is actually there. If you can see it clearly in the rent roll, that's real. If it's based on projections, that's more of an execution risk. Best case, you've got a clear in-place loss to lease that makes early growth more predictable. So the question we focus on is how much of that year one growth is already in place and how much has to be created. Um, so what we're focusing on is micro level supply, real versus projected rent growth, timing of concession burn off, and expense assumptions. So it really boils down to one question: what has to go right for a deal to work? And if the answer is a lot, we generally move on from that deal. So there's opportunity in this market, but you do have to be selective. It comes back down to, downside protection, alignment with the operator, and realistic underwriting because everything flows through that rent growth, expenses, financing, and that exit. Um, to bring that into context with a real example, Clay mentioned one of our investments in Houston. This is the Preserve at Copperleaf in Houston, and it's a deal that we closed in 2024 and have already had a cash out refi returning about 40% of investor capital to the investor while they maintain their same ownership in the deal. And this deal aligned with what we were looking for. It had strong location because we analyzed the submarket and saw that that new supply was limited. There was low execution risk. This wasn't a heavy lift. We weren't planning on spending a lot on interior upfits and then pushing rents by $300. It was with an operator that we trusted, had a solid track record, and we've known them for years. And the returns made sense without stretching those assumptions, and it had a reasonable hold period. Importantly, it had a clear upside through a tax abatement strategy, which at the time enrolling the property into was almost a given. But I'll give you a word of caution here. That tax abatement environment is changing in a lot of states today. So if you see a deal where the business plan largely relies on entering a property into a tax abatement program, I'd proceed with caution and just make sure there's a solid plan B. Um, so this is the type of deals we focus on where the path to returns is clear, doesn't rely on everything going right, And unfortunately, this one has gone extremely well, and we see this one continuing to be a win for us and our investors.
Rob,
Um,
can I stop you there for a second?
yeah,
So,
sure.
on a lot of deals that I've seen, specifically in Texas, tax abatement is like a key part of the strategy. Can you talk about kind of real examples that you've seen where I guess the tax accommodations or the tax conditions have changed and that adversely affected the that strategy?
Yeah, no,
Absolutely.
Since Clay sits in Texas, maybe we'll let him take that one.
Sure.
Yeah. So it actually did change in Texas. You had PFC and HFC tax abatement programs. And a lot of operating or a lot of operators and sponsors were using this program to relieve themselves of those property taxes. And they were doing it in accordance with the law. And but there was some pushback on whether that law or whether that program should be allowed. And so the governor, I suppose, signed a bill that allowed that law to change, and it actually went retroactive. So for every operator who used a specific type of program to get those properties enrolled in the abatement, for every operator that did that and did it in a specific format and structure that the law mentioned or that the new law disbarred essentially, they had to start paying property taxes again. And it actually could cause some deals to come to market because there was a grace period in there of like, you'll have to start paying property taxes in 2027 or something like that. And so if you're looking at a property tax abatement in Texas, I would have a really, really hard look at that and make sure that the operating partner shows you clearly where they're not going to be affected by that recent law change. Fortunately, it is out there. This property that we just mentioned to you, this was not affected by the law change. So you just need to make sure that it's done in a compliant and correct structure. But absolutely, people are struggling because of the changes in law that Texas saw.
Perfect. And then in regards to not just focusing on the city, but actually drilling down to the specific submarkets, um, you guys are looking at a lot of deals. How is this? How how well disciplined are the operators to actually identify the submarkets rather than just sort of like hang their hat on the 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 growth of the city at all? I mean, I from your presentation I can tell if someone's not looking that deeply, then you're probably going to pass on them. But I'm just kind of curious to understand how um, is this common with the operators you're working with that they are drilling down to the submarkets, or is it just sort of coming to light for them?
Yeah, absolutely. I mean, I think it's been brought into focus a lot more recently because they're seeing their other properties struggle in various submarkets, and so now it has become a very major focus for many owners and operators. And you're right. The operators that we work with, we hope that they're doing their due diligence on the specific market, and of course, we're doing that due diligence as well. One thing that you can do as a limited partner that might be helpful is ask for a CoStar report of the specific area. The operator should be able to pull this no problem. So you're not inconveniencing them by asking too many questions or anything like that. You should ask the question and ask them to send you a report of what's going on in that submarket so that you are able to decide for yourself what that supply picture looks like. And that report will you'll be able to read through it and see what new apartment complexes are coming up in the area. So that's one thing a limited partner can do. And then, yeah, I think good sponsors, they should be looking at the street level view and make sure that they're accounting for all the different dynamics there. And if your sponsor isn't looking that deep, then definitely I would have some questions about whether you should and place your capital with them.
When you have a place like we'll use Houston because that's where you are right now, right? And I was there in October. It's obviously it's really exploded. Um, uh, in these kind of, I'll call them like 3 to maybe 5 mile pockets or 1 to 3 mile submarket pockets. What are often the reasons that there isn't development going on in those submarkets despite all the development going on throughout other parts of the city?
Yeah, great question. A lot of times it has to do with the particular municipality that it sits in and whether those people specifically are open to development or not. Another thing that plays a huge factor is whether there's any land to build. Sometimes there's just not even enough land to really build anything in a particular area. So that could have a lot to do with it. And then just various paths of growth. So changing the conversation to Dallas a little bit because it's so clear there. Well, I won't say all, most of the supply is going north because that's
Hmm.
where the path of growth in Dallas is. It's all going north. And the dynamics of that growth are incredibly strong. You have great jobs, great incomes, great people, and everyone's going north. Yet, if you go east a little bit, you're not going to see the same amount of growth as you would in that northern corridor. But what you are seeing is less supply. And so sometimes developers bypass those lesser areas as far as job growth goes and income growth goes to go to that northern area because that's where they know that all the growth is happening. But that's also where you end up with the most supply. And so there's various dynamics at play there that, you know, to your question, will dictate how many units get built in a particular area.
Yeah.
And Dallas was kind of on my mind. I'm glad you brought it up. So when you look at opportunities in and around Dallas, do you say, okay, we know what's happening in that northern quarter, like you said, let's go identify some submarkets there? Or are you more interested to see what developers are doing, what developers might be doing east of Dallas because you see like that's the greater opportunity? Or is it I guess it's a little bit of both.
Yeah, I would say the way we analyze a lot of our deals is instead of identifying submarkets first and foremost, but we'll sort of rely on our operating partners to do that piece of it. And then when they bring us a deal and say, "Hey, do your investors want to invest in this particular opportunity?" Then we take a bottom up approach. We'll start at the deal, we'll start at the street and move out from there and say what's going on within a mile, and then move out from there and say what's going on within 3 miles. And so that's generally how we analyze deals. But yeah, I think that every deal makes sense at a particular price, or I should say most deals. And so if an operating partner is going to go under contract on something in North Dallas and it's just getting hammered with supply, but they're buying it at a 6.5 cap, like just to be kind of silly about it, then that's something that we can more than likely handle and we can potentially get on board with depending on what it looks like. If it's a 6.5 cap, but it was built in 1945 and it's falling down, then no, we won't take on that opportunity. But if it's a 6.5 cap and it's a 2010 build and it sits in the path of growth, and we know that we're going to have soft operations for a couple of years, but then we expect that some of that supply to be absorbed because even in places like Dallas that continue to see new developments, it is going to be much less than the last 3 years or so. And so that growth is coming in Dallas. And you actually have operators and large REITs who are saying that Dallas is starting to firm up. Occupancies are starting to increase. And so if you can handle and you're underwriting and projecting soft operations in the first couple of years and you go in with a longer term mindset of maybe a 5 to 10 year hold period and sort of look to that future growth, then that's a story that we could potentially get behind. And that's a story that many people are looking for right now.
Yep.
Great. Um, so this is going to pivot a little bit. You know, you're talking about operational partners or operator partners. You guys are obviously identifying operators to partner with. You're not developing the projects themselves. What are, I imagine I'm, an investor coming into your deal and you tell me, oh, you're not the ones who are actually there doing the deal. That doesn't that may not sit well with me. But what are the advantages of you coming in as an equity partner uh, and finding these operational partners?
Great question. And that's
Yeah.
certainly one we get quite a bit. And I would say, first of all, you're benefiting from the level of due diligence that we're able to do from a couple of different perspectives. Number one, we're placing our own capital into these deals. So we want to make sure that it's a good opportunity for our capital and a good opportunity for you as well. Um, the next thing too is when you're writing $1 million or $1.5 million or $2 million check into some of these opportunities, you're going to first of all require, but also be able to access deeper due diligence. So we're looking at and asking as many questions as we possibly can about a given opportunity to make sure that we're not missing anything that could be a ginormous risk within the deal. And so we're able to have multiple meetings with our operating partners and get to know them over the course of years to make sure that we're making a good decision when we're bringing our own and our investor capital into a deal. And that's something you might not be able to get if you're writing a 50 or even $250,000 check. Just quite frankly, the operating partner might not have time to answer all of your questions. And so that's one area where we can potentially throw our weight around a little bit and make sure that we're getting every single question that we need answered. The next one, and probably the largest reason you would look to invest with a firm like ours, is when we're writing these larger checks. So many times we can demand or negotiate better terms for our capital rather than what you might get going direct to the operating partner. And so if we can go in and negotiate a higher preferred return and a better profit split on the back end, then we can pass on some of those uh, better terms on to our investors, and you can actually end up making more money with a firm like ours rather than going direct to the operating partner. Um, the
Hey,
next thing
Clay,
there
Clay, I'll,
too,
uh, Clay, along those same lines, I'll just jump in real quick. A lot of times, if you're going direct to some of these larger operators, they have a minimum, 250 or more. And part of what we can offer is a lower minimum entry into the deal, as well as those preferred terms.
that's exactly right. And
Yeah.
and then the last thing too is just access. Like we're looking at so many different deals on any given week or month that um, you know more than likely we're seeing many of the deals being done in the areas that we focus. And so that allows us to hopefully pick the best opportunities that we can for our own capital and our investor capital.
Yeah.
So, and that was going to be kind of my follow-up question is we talked about Texas a lot within the Sun Belt. Is that the primary focus, or I mean, obviously it is a focus. What are other places do you like to look at for deals?
Yeah, we
Yeah.
really
Go
like
ahead.
North Carolina, and like I said, I'm sitting in North Carolina now, so we love the Carolinas, Central Virginia, so we are evaluating deals in those areas for sure.
Yeah, then I'll just add to that Houston is still interesting to us because of some of those supply demand dynamics. Supply has certainly dropped off in Houston. So we think that it could be ripe for opportunity. And then the Carolinas, as my dad mentioned, Virginia is a place that we're going to look. And there's also some of these coastal cities that we've been looking at deals in. We haven't done a deal here yet, but like there's particular parts of even like Murrells Inlet, which is south of Myrtle Beach, and it has particular sub pockets that didn't get hit with as much supply. And then you're also a little bit constrained on where you can build. You asked earlier about, why does that happen? And in some of these coastal cities, you just can't build in many of the areas, or it's very hard to build because of flood zone or stipulations that the area has. And so in places like that, maybe like Savannah or particular spots in Charleston, you can get a little bit more of the feeling that you're protected from some of that new supply while also benefiting from the job growth and the population growth that a place like Charleston might have. And so that's another kind of nuance there. And we're looking for a deal that fits all of our criteria in those areas.
Nice. Um, we were talking earlier, and you kind of described a special, or you described a streamlined process for specifically self-directed IRA investors to participate in your deals. Can you talk a little bit about that, knowing that our audience are Camel Plan
Sure.
clients with holding self-directed IRAs?
Right, right. We have quite a number of our investors are investing through their self-directed IRAs, and so we have a pretty seamless setup. We employ a third-party fund administrator who assists all of our investors, self-directed or not. Once they have committed, then they help through the beginning from signing documents to funding the investment to reporting and K1 distributions at the end of the year. So that third-party administrator really is a key asset for those investors, and they act as a liaison between the Camo plans of the world and the investor and us, and make sure everything stays on track and above board.
Beautiful.
Yeah,
Yep, I know. A lot of our clients are very, very busy people, and sometimes it takes it's a big ask to get their attention and
yeah,
time focused on things. And these are investments, right? So no one wants to be in a rush. So I think that's a great
right.
service that you provide, or that your third party provides.
Yes, very much so.
Absolutely. It streamlines the process quite a bit.
Yeah,
So we
yeah.
like it.
We don't have any more questions, so I think we can go ahead and wrap it up. If you guys want to close it out and share anything, talk about kind of anything related to investments right now, or whatever, to the extent that you can talk about them, or best way to contact you, things like that.
Yeah. Yeah, thank you. As you can see on the screen, you've got our contact information there. The QR code actually will give you access to a due diligence checklist that you can use as you're looking at deals. We're happy to jump on a call. We're all about learning based and education. So we're happy to, if you're new to this type of investing, we're happy to jump on a call and talk you through that a little bit. Thanks again for joining in, Clay. How about you?
Yeah, really appreciate Camo Plan for having us on. Appreciate you all for jumping on the call. As my dad said, we're more than happy to discuss further and discuss where we think more opportunities might lie. As far as active opportunities, we continuously allocate capital to our real estate private credit fund, and that is an active opportunity you can find on our website. We're very pleased with the performance so far, and the beautiful thing about investing into a deal like that is that you get to see and have access to the last 2 years of performance. So that could be helpful in your decision as you look at that. But we'll look to do anywhere between 3 and 5 sort of standard equity deals per year. But we try to bring the highest quality kinds of opportunities to our investors. So if you'd like to be included in that, then feel free to reach out. And again, we appreciate it.
So you have the private credit fund, which is on kind of a continuous raise, and then the you say 3 to 5 equity deals throughout the year.
That's
Correct.
correct.
Yeah.
And any, I know there's always rules about how much you can share. Anything you can discuss in terms of like investment minimums for those different opportunities?
Yeah, I think that would be fair. Generally speaking, with the multifamily equity deals, the investment minimums are 50 to 100. we had a couple of newer investors who wanted to get involved in that real estate private credit fund. So we actually lowered the minimum there to $25,000, which is not something that we'll do on many future opportunities. But for that one, I think it's a nice value add and gives people the opportunity to get involved at a little bit lower check size.
And I assume accredited investors only for both opportunities, both kinds of opportunities, correct?
Great question. So on the real estate private credit fund, that is accredited investors only. Some of our opportunities on the equity side of things can include some non-accredited investors. I would just, we definitely need to make sure that we're aligned on what that deal looks like, the risk profile, make sure that, everyone understands the risks involved, accredited or non-accredited.
Sure. Okay.
Correct. I'll add to that real quickly too. On those ones that do accept non-accredited investors, we do need to have a relationship prior to talking about that deal. So the quickest way to do that is to sign up on our website for our newsletter. I usually reach out within a day or so and set up a time to get together and talk. And so then they're moving forward from there, then we can show you all the deals that we are offering to our network.
I really like hearing that because I know what it's like to raise capital, and it's really easy to just focus on bringing it in, but you want to make sure that the people who are investing with you know what they're getting into, and they're going to
Yeah,
be just like you look for good operational partners, you want to look for good investment or capital partners. So good on you
100%.
for being that thorough.
Yep.
Um, Thank you guys for being here. Great presentation. For those of you in the audience, you can see the contact information here in front of you. So please do reach out and get to know these guys, learn more about what they're doing. This presentation will be shared with all of you as a recording. And other than that, I'll say have a great week, and we'll see you on the next one.
Thanks,
Thanks, Matt.
everyone.
Thank you.
Thanks,
Bye bye.
everyone.